Great. Thank you very much, Andy. Thank you, everybody, for being on the line today. I appreciate this opportunity to share some thoughts and ideas with you around where the world of banking is going, how fintech is going to impact it, especially from a business model perspective, and how it transforms the relationships between financial institutions, startups, merchants, vendors, and consumers as well. If we go back a few years, say post-crisis, banking's gone through a pretty interesting time. A lot of pundits were calling for the death of banks over the past 10 years, and we started seeing books and publications with titles like The End of Banking or Bye Bye Banks. Now, to be fair, it wasn't all doom and gloom. At least these guys put a question mark at the end of their title. But over the past 2 years or so, the zeitgeist has changed in the industry, and people aren't talking about the death of banks anymore and how financial startups are going to displace banks. But now that the talk has turned towards how banks and fintech startups need to partner. And so now we start to see new publications with titles like Building a Better Bank Through Fintech Partnerships, or Global Payments, How Fintech Partners Are Helping Banks Transform. Now, I've got to tell you that every time I hear talk of how banks and fintech startups should partner, I can't help but think about Jack Nicholson in the movie A Few Good Men. But what I hear Jack saying is, you want partnerships, you can't handle partnerships, because I think the reality is in the world of banking that few financial institutions have the skills and resources to partner effectively. Got to remember, of course, that the vast, overwhelming majority of financial institutions in the US have less than $10, $20 billion in assets. And reality is they just don't have the skills, the resources, the capabilities, the competencies to partner with any meaningful number of fintech startups. One-off partnerships to create a new capability from an online or mobile banking perspective is nice, but reality is that really going to attract new consumers or change the economics of the business? And on the other side of the equation, even for the largest financial institutions who do have skills and resources to partner, the reality is that the complexity of those institutions is so difficult to penetrate that, again, a small startup isn't going to have a meaningful impact on millions of consumers in any particular short period of time. So I think the reality is that most institutions really aren't going to benefit much from these partnerships. They're great to do as experiments, but they're not things that are going to scale. And the reality is that it's really not so great from the other side of the coin either. I had the CEO of a fintech startup tell me recently that the biggest barrier to bank fintech partnerships are banks' procurement departments. He said, they treat us like small IBMs and hammer us with performance and risk clauses that would kill us if we let them. So I think the reality is that partnerships are not going to scale in banking, and it's great for experimentation purposes, and I'm sure it sounds great to the board to tell them that you're doing things from a fintech perspective, but it isn't really going to play out. What's needed is a different approach to integrating fintech startups, and more importantly, new technologies that the fintechs are bringing to the table. And I think that's going to happen through the emergence of a new business model in banking, a platform business model. Now, for better or worse, the term platform has been around for a long time. Many banks think of they've got a lending platform. They think of their online capabilities as an online banking platform or a mobile banking platform. But I'm using the term in a different context here. I'm using it in the context of a business model, not a technology construct. A business model that you can think of as a plug-and-play model that enables buyers and sellers to easily connect, interact, create, and exchange value. What distinguishes a platform business model from other business models are three key capabilities or criteria that must be met in order to be a successful platform. That first capability is you must be a magnet. You must attract both buyers and sellers to your platform. Reality today is that most banks and credit unions are actually decent magnets for buyers, that is, their customers or members. They do a good job of attracting, or many do a good job of being a magnet to attract consumers, but they're not attracting or acting as a magnet for other sellers of other services. So today's banks and credit unions aren't really a platform at all, even though they do have some magnet capabilities. The second key capability of a platform is the ability to be a matchmaker. That is, to match the buyers and sellers on your platform. And the third key capability is to provide a toolkit to enable the ease of integration and transactions that occur on your platform. Now, as I describe these capabilities, I wouldn't be surprised if one of the best examples of a platform business comes to mind in your heads, that of course being Amazon. What's interesting about Amazon as a platform or as an example of a firm deploying a platform strategy is how it has evolved over the past 20 years or so. When it first started in the mid-90s, it was really nothing more than a B2C, a business-to-consumer e-commerce website, which is what it did for pretty much the first 10 years of its existence, becoming in effect a magnet for buyers and then for sellers of other products as they expanded beyond books. Around 2006 timeframe is when Amazon launched Amazon Web Services, in effect launching the toolkit capabilities to become more of a B2B or business-to-business e-commerce toolkit. And they built that up as a separate business, as well as it being able to utilize it to improve the consumer side of the coin. And from about 2011, 2012 on, it has now become more of a B2B2C, that is business to business to consumer platform on its way to a market cap today of in excess of $680 billion. And of course, along that time, it has gotten into financial services as it has provided payment services and has done over $1 billion worth of merchant cash advances over the past couple of years. And I think one of the big questions that kind of remains and is sitting in front of the industry now is, well, what will Amazon do from a banking perspective? So I'd like to get you guys involved here for a moment and ask a poll question here and ask you what you think Amazon will do. And I've got a couple choices I'd like you to choose from. Do you think it will offer a checking account itself within the next 2 years? Do you think it'll offer a checking account itself, but maybe not within the 2-year time frame, but let's say within 5 years? Do you think Amazon will acquire a bank in order to get into banking? Or do you think it will do neither offer a checking account or acquire a bank? So let's go to the poll. I'll give you a few seconds here to give your answer in, and when we get a decent number of responses, we'll show the results. And I am going to give Wendy a couple seconds here to track that and figure out where we are on the answers, and we'll wait for her to post the numbers. Okay. Are we about there, Wendy?
Yes. I don't believe that you're able to see the results, so I will read them.
Excellent.
I will read them to you. 40% chose 1, 5% chose 2, 40% chose 3, and 15% chose 4.
Okay. Well, overwhelmingly, we can conclude that you all think that in one way or another, Amazon is going to get into a checking account or into banking more broadly. Honestly, I don't know what Amazon will do, but I do have an idea of how consumers will respond to it. I recently surveyed a little over 2,000 US consumers and was not a representative sample. Chose to survey consumers between the ages of 21 and 72, so millennials, Gen Xers, and boomers, but not silent generation members. And the other criteria was that they had to have a checking account, so these were banked, not unbanked consumers. And they had to have a smartphone because I was more interested in what the impact of mobile was going to be. Now, if you think that I was excluding an inordinary number of boomers by my smartphone criteria. I've got news for you. 2/3 of baby boomers today have a smartphone. So it was pretty representative, even though we didn't survey consumers older than 72. And when I told consumers or respondents in the survey, they said that Amazon is thinking of offering a checking account, and for a $5 to $10 monthly fee, the service would include cell phone damage protection, ID theft protection, roadside assistance, travel insurance, and product discounts. Now, reality is that I have no clue what Amazon is going to do, actually, but I figured I could tell consumers and respondents that this was going to happen. More than 4 out of 10 millennials said that they would open this checking account, and actually a quarter of them said that they would actually close out their existing accounts. So there is huge interest. Reality, of course, is that even though 43% they said they would do it, if Amazon actually did it, I'm sure that number would be much smaller. But this is a strong indication of a couple things here. First, of the impact that Amazon could have on banking, but very importantly, it's also a demonstration of how consumers are looking for value beyond just the checking account and would be willing to pay for things. Now, while Amazon is a great example of a firm pursuing a platform strategy that could extend into the world of financial services, it's not like existing banks and financial institutions are sitting around and doing nothing. A number of large banks are actually out there building platform toolkits themselves in the forms of API marketplaces or developer exchanges. BBVA was one of the first out there, having developed it in Spain before bringing it to the US. Capital One has their developer exchange. Citi, Deutsche Bank, HSBC all have some form of API platform or developer toolkit in which they are building the capabilities to become a platform. Even though I don't necessarily see a lot of movement in their business model so far, they are building out the capabilities to pursue a platform type of approach. We look at what's going on in Europe as well and see a number of European neobanks, startups, who are pursuing a platform strategy. Starling Bank announced that they're building a marketplace of products and services by partnering with smart apps. And Fidor Bank in Germany has developed a whole set of APIs as well to enable third parties to integrate in and access account information, customer information, card and payment trends and information, and hook into lending, overdraft, and money transfer as well. So will these approaches and will banks, can they be successful in kind of opening the kimono a bit and not just being open to other financial services, but to other products as well, other types of services like an Amazon? Well, when I asked consumers and told them again about what Amazon was planning to do, I asked them how interested or willing would they be to actually purchase these types of add-on services from their own banks. And more than a third of millennials expressed interest in purchasing these types of value-added services from their bank. So it's not like the threat from Amazon is going to kill the banks. There's opportunity here for banks to pursue more of a platform strategy themselves and open the door. This trend towards platformification, however, is not just happening from technology companies and large banks themselves, but also happening from a marketplace lender perspective. Many of the marketplace lenders that have emerged over the past couple of years, Lending Club being a good example, have sort of fallen on some harder times over the past, in the most recent years, as the economy has improved, as consumers have emerged and matured a bit and improved their credit scores and economic standing. The marketplace lenders are struggling a bit to find the success that they had when they first started, and are migrating their strategies. And what we're seeing is that many are becoming platforms themselves. One of the best examples of this is Cabbage, which is actually branding itself as a platform and starting to build out that toolkit as well by creating connections to access data with companies like eBay, Stripe, Square, Yahoo, Amazon, Etsy, and PayPal as a means of helping to improve the flow of data, to enable lenders to make lending decisions based on alternative data and alternative data sources, and helping to not just be a marketplace where consumers or small businesses or even larger corporations could get funding, but to provide more of the mechanism for the processing and underwriting of the loans itself that is becoming more of a lending platform. The other thing that I think is very important to understand in terms of this move towards platformification in banking is the emergence of a whole new set of vendors as well. I call them platform services providers, and they take a couple of different forms. One particular form is represented by companies like Constellation, Sandbox, and Fedor Solutions, which is a subsidiary of the German bank, but not to be confused with the German bank. And what these organizations are doing are providing mechanisms for financial institutions to better choose between financial services vendors, fintech vendors, not just startups, but existing vendors, to better to get more best of breed and to provide better integration services and migration services. So in effect, whereas you think of Amazon as a platform that attracts consumers and sellers of services, these platform services providers in banking are creating platforms to attract the banks and credit unions as buyers and other fintech companies and financial services technology companies as the sellers. Another example of a platform service provider, a company called FISpan, which is enabling banks to provide business banking capabilities and getting best of breed from a number of different providers. And this move towards platform service providers is also being demonstrated by firms with even more narrow approach, companies like Avoca, which is focusing more on account opening and authentication, or Nice Actimize, building platforms out for integrating AML, compliance, and financial crime prevention type capabilities. So what's emerging in the world of banking are a number of different types of platforms. There are technology companies who are providing platforms where the buyers are consumers and businesses, and the sellers are merchants, financial institutions, even fintech startups. There are platforms where the platform creator or platform sponsor are the financial institutions themselves. The buyers are consumers. The sellers are other financial institutions or perhaps fintech startups and vendors. There are platforms where the sponsor is the marketplace lender, like a lending club or Cabbage, where the buyers or borrowers in this case are consumers, small businesses, and even could be mid-sized to large companies, and where the sellers are financial institutions and investors and even consumers themselves. And the fourth type, where the platform service provider is the sponsor and the buyer is the financial institutions and the sellers are fintech startups and existing vendors. What's happening here is fundamentally platforms are becoming the new banking battlefield. So let me share with some concluding thoughts here of I think what's happening here and what the implications are of this move towards the platformification of banking. First of all, it's changing consumers and financial institutions, not just shopping, but buying behaviors. It's changing the transaction. What's happening and what differentiates platforms from a marketplace is that the marketplace just kind of brings the buyers and sellers together, but doesn't enable a lot of the transactional capabilities that happen post-purchase decision. That's what's different in the platform. It's not just the shopping behavior that's changing, but the buying behavior, the processing behavior, and which gets pretty complicated, as you know well know, when we talk about lending types of transactions. Second is creating new business models in financial services. Although I think the large banks have been building out the toolkits, they've been slow to change the business model. But the world of moving away from simply charging for checking accounts and expecting to drive profitability through interchange and monthly fees, the potential profitability of the core account can come from the integration and sale of auxiliary types of products and services, like what I was asking consumers about in the Amazon example. Third implication is the emergence of new vendors, companies that are becoming platforms, and especially those platform service providers who are creating a new level of integration across existing financial technology companies and institutions, and creating new economics for integration, and especially new economics around the ability to do migration from existing platform or existing technology providers and new ones. And fourth, and I think also very important, is this trend towards platformification is creating new transaction-related fraud threats and challenges, but enables new risk and compliance approaches. When the transaction, whether we're talking consumer buying things on Amazon or lending type of decisions that are happening on the marketplace lenders, or even transactions that are happening on the platforms of these new platform services providers, it creates new challenges for managing the fraud and compliance. But because of the integration of data on these platforms, there could be some benefits to folks managing risk and compliance. So wanted to lay out some thoughts and ideas here in terms of this trend towards platformification. And I think we've got a few minutes here to take some questions and see if I can provide some answers to you. So Wendy, I don't know if anything came in during the during my talk here, but if anybody has anything, please submit it through the GoToMeeting panel there, and hope I can address some of your questions.
We don't have any questions at this time.
Okay.
If you like. We do have a standard question. Is platformification the same thing as open banking?
I think they're similar in somewhat concept, but I think in reality and practice, they're two very different things. I think the move towards open banking is really more about data sharing across institutions and even providers. It doesn't have to be financial institutions, where it's more a focus on the data, whereas platformification to me is more about a business model change and changing pricing, changing the packaging of products and services, changing the offering, to change the economics of the relationship between the buyer and the seller, in this case, from a banking perspective, the consumer who is, let's say, opening up a checking account. That's, I think, is when we think about open banking, I think that's what I'm hearing, is that's mostly about data sharing. And I want to try to make the distinction here that I think what's happening in banking and around platformification is more about business model change and not simply data sharing, which I think is what's driving the open banking movement.
All right, I believe we had a question come in. Will platformification likely result in the desegregation of banking services, or will banks further consolidate through acquisitions?
There's a couple things going on here. First, I definitely do not think it decentralizes, or was the word desegregation in that question? Was that, did I get that right? Yeah. No, it doesn't desegregate. In fact, just the opposite is that it tends to aggregate a bunch of services under a single umbrella or platform, I guess. But while this trend is going on, there are still going to be plenty of financial institutions looking at growing through acquisition and mergers. And it's funny, as we speak, there's a big conference going on in Arizona called the Acquire or Be Acquired Conference, where there are more than 1,000 attendees all kind of sniffing around each other looking for acquisition deals. But that is a response to the reality that today, if you're a financial institution in the US with less than $1 billion in assets, you're looking at a huge cost structure from a technology, delivery, and regulatory compliance perspective in order to have to meet those requirements. That makes it tough for smaller institutions to succeed. So we're still going to see a move towards acquisition and mergers that's driven more by scale. But the move towards platformification is more about offense and defense, to defensive move to the threats of the Amazons of the world, who have created such a strong magnet, matchmaking, and toolkit capability to get into financial services. And the reality is that to respond to that, banks are and credit unions are going to have to change the value proposition of their accounts to almost mirror exactly what Amazon's doing, and expand the value proposition of the types of accounts in order to grow. So it definitely does not lead towards the desegregation of products and services. But one of the interesting implications of this is that there's no reason why a large bank like a Citibank or JP Morgan Chase, who might pursue a platform strategy, not just opening up data, but opening up to other types of product providers and service providers, and actually including smaller financial institutions in that. Reality is that they're not going to get 100% of the business anyway, and so why not get a cut on some business that gets referred or goes to a smaller financial institution that a consumer finds them through the Chase platform. I mean, that's what's happened in the retail world, is that people shop and look for providers, products, and services on Amazon today, and the threat is that they'll just continue to do that and look for financial providers on that platform. So a bank pursuing a platform strategy that only sells its own products and services from a financial perspective is probably doomed to fail, and because this is no different than the financial supermarket concept of 30 years ago, back in the 80s. Nobody shops at a supermarket that only has one brand. So the move towards desegregation isn't going to happen. It's going to be the opposite. But to succeed as a platform, large institutions are going to really have to change business model. And it's going to be a big cultural change, but the threats of external providers like an Amazon is going to force that change over the next 10 years.
Okay, next question. How do you expect banks to fight back against startups who are seen as disrupting their current business model? For example, do you expect pricing battles, banks acquiring new technology, etc.?
Well, at the risk of ticking off the person who answered that question, I actually don't think the fintech startups are posing that much of a threat to the existing business models of today's established banks and credit unions. And I think that I was trying to get at that the early part of the presentation, when I was trying to show that the zeitgeist in the industry has kind of changed from the perception that all these startups are going to cause the death of banks to, wow, we need to start partnering. The partnering move was not just banks looking to partner to get new technology. It was also a move on the part of the fintech startups, who learned the hard way that scaling a business is not easy in the US or anywhere else, I imagine, and that to go direct to consumer is a business model in the US takes a lot of money, and they don't have that money. So they found that, well, what's the best way to do it? Well, look at Citibank. They got 50 million customers. Look at Bank of America, Chase, 100 million customers. Let's go through them. So I don't see the fintech startups as a real threat to the business models of the existing banks. I think but I'm also not a believer that simply partnering with them is going to work, because of the complexity of partnering, because of the lack of skills, the time it takes. Amazon sells products and services from I don't even know how many different providers, but it's got to be in the tens, if not hundreds of thousands at this point. They don't partner with those. There's a standard contract. You want to sell your products and services on our platform? Here are the rules you have to abide by. By the way, we'll charge you money to help you figure out how to better market your products and services on it. That's a benefit of the business model. And then Amazon, through the success of being a successful magnet, starts to understand a whole lot about consumer behavior and what people are buying and what they're not buying, and who they're buying it from and not buying it from, so that they can make financing decisions to make loans to merchants in the form of merchant cash advances. So the fintech startups I don't see as a big threat to the existing bank business. It's the companies that are going to come in with a platform strategy, uh, aggregating, integrating lots of different providers of various products and services, and doing smart bundling of products and services that are the value added to consumers. That to me is the bigger threat here, not the startups.
Okay, and one more question. The culture of traditional banks and the culture of fintech startups may be very different. In a scenario where a traditional bank acquires a startup, how would you advise the acquiring bank to facilitate a smooth integration of the startup into the bank's culture?
Yeah, I'm glad that question came in because I have some pretty strong opinions on this. Have you ever stopped to wonder why a startup has a culture of innovation? I think one answer to that question is because they don't have any customers they have to take care of. It is so easy to be innovative if you don't have real customers to take care of. But yet, as soon as they grow big enough to have to take care of a bunch of customers, watch that so-called culture of innovation start to wither away. If a I don't even care if it's a large bank or a mid-sized or even small bank acquiring, or any type of company acquiring a small startup, expecting that acquisition is going to change the culture of the acquiring company is a huge mistake. Um, there's a famous saying, I don't know who said it, probably Peter Drucker, that culture eats strategy for breakfast. And it's overworn, but it really is true. Culture is going to overwhelm a lot of strategies and tactics that you might want to employ. So thinking that simply acquiring this bank startup, and I'm going to give you a good example of this, and I'll try not to embarrass anybody, but I won't say the name. But there is a bank located in the area where I am, so you can figure out where I am and then figure out what this bank might be, who actually acquired a failing startup and basically employed the whole startup's management team as the bank's innovation lab. And they were successful for some years in developing things, but as a mechanism for changing the culture of the broader bank, that never happened. And so if the purpose of the acquisition is to take this culture of innovation that the startup has and make the rest of the institution or company more innovative, I think that's a prescription for failure. There should be much more of an economic rationale for the acquisition, whether it's, we're going to run this thing, help it scale, make some money on it, or we're going to use that technology, deploy it internally to create advantages in the core business. But if it's, this culture thing and we need to acquire a bunch of people to change the culture of the business, I don't think that'll ever be successful.
And that's all the questions we have.
Great. Well, I appreciate all this opportunity and time to share some thoughts and research with you today, and I hope this has been very helpful.
Thank you, Ron, for sharing your expertise during today's session, and thank you to all who attended. The recording of this session will be available within 48 hours on Premia's webinar archive page. Thank you, and have a great rest of your day.